Hi, I'm Karen Alexander. This is part 3 of my recordings on the impact of Covid-19 on financial markets and banking and the wider effects on the global economy. So let me share my screen. This is the third part. Just to remind you, the first part I was talking about the Great Depression and finishing with the Exchange Stabilisation Fund. The second part I was talking about the banking crisis, finishing with quantitative easing and the new repo operations introduced last year in September. And in this part of the talk, I'm going to talk about new tools for this very extreme monetarist policy that the Federal Reserve is implementing now, and how it's now become the lender of the last resort, the underwriter of the last resort, the market maker of the last resort. And then I'm going to be looking at who are the winners, who are the losers, talk about the dislocation in financial markets at this time. They're not moving according to traditional economics at all, and the reasons for that. Looking at the prices of safe haven assets like gold and Bitcoin, and finally summarizing with what I believe is a reasonable assessment of the global economic outlook in the next year or two. So I should make this a bit bigger. Here we are. Okay, so here is the announcement that was made on the 16th of March. Unprecedented repo operations. So in accordance with the most recent FOMC directive, the open market desk, the trading desk with these primary dealing banks, will conduct a series of overnight and term repo operations to support effective policy implementation and the smooth functioning of short-term US dollar funding markets. So at the end of the last part, I talked about money market squeezes and the need to inject more funds into short-term funding arrangements. So if you go and have a look at that and click on historical repo operations schedules, you come up with a spreadsheet that is particularly difficult to use, but in fact you have to read this graph backwards. So what this graph shows on the right-hand axis is the aggregate operation limit in billions of US dollars. So, and this is September, this is more recently. So these operations are continuing now with an aggregate limit of $500 billion each one. And if you look at what happens, there's an auction each morning from 8:15 to 8:30. And the limit is $20 billion. Sorry, yes, $20 billion per auction. Some of them are just overnight. In fact, most of them are, but there are also term auctions as well. So repo is a sort of printing dollars on tap. There can be reverse repo as well, where the US actually sells securities into the money markets, but most of these repos are actually buying back Treasury bills and injecting money into financial markets. So this direct repo, as opposed to reverse repo, you can see the operations are actually dying down now. I've drawn you this graph. You can draw plenty of graphs from the data at the Federal Reserve Economic Data. The interest on excess reserves, that's this blue line here, has come down from 2.5% to 0.1% now, which means that if commercial banks or other banks have reserves in excess of their capital requirements, they no longer earn interest on that. And this is a tool that, a new monetary tool to try to make money go from the commercial banks who are getting it in these repo operations. And instead of holding on to it, they should pass it on in loans. And one way to encourage that is to make sure they get no interest on any excess reserves, and they get more interest by making loans to companies. So the right-hand side, you can see billions of US dollars. That's overnight repo operations, 160 billion, 120 billion, going on and on and on, just overnight. I couldn't get the data for the term operations. And at this point here, they were actually doing reverse repo. I don't know whether they'll be doing some more of that now, trying to claw back some of that cash that's been injected into the system. But nevertheless, the balance sheet, the total assets and liabilities of the Federal Reserve has grown since the banking crisis of 2008 from 1 trillion to 7 trillion. And most of that, this is the period of Janet Yellen trying to keep a cap on it. And this is what happened when Jerome Powell started, and more recently, it's just expanded by 3 trillion already, up to 7 trillion. And that's nearly 1/10 of world GDP, annual GDP. So nearly 1/10 of all the goods and services and manufacturing and all the products, agriculture, everything we make in this world, about 1/10 of it is owed by the Federal Reserve. And I've drawn this green line, which is the S&P 500, to show that it's gone from, I mean, we saw how it marched up in the 1950s and 60s from 200 to 800. This index has now gone from 1,200 to over 3,200. And although it did decline very sharply down to the levels from when quantitative easing was originally stopped, this was the point where repo started, and this supercharged repo now is that money is being used to buy US stocks. General Motors and other zombie companies are being propped up, not just by company bonds being bought by the US, but also their stocks are being bought by hedge funds and other large financial institutions. So the money supply obviously has gone up. Here you can see as the M2 measure of money supply goes up, so have the assets of all the commercial banks, whereas the velocity of money, that's the sort of Keynesian multiplier. You know, if you give, if the commercial bank makes a loan of $100 to the baker can then buy goods from the farmer, and the farmer can buy machinery from the manufacturer, and the manufacturer can then buy a house, and so forth. So this is the velocity, the money circulating, and it's just been going down and down and down, because this quantitative easing is being used to make the rich richer, and the ordinary householders are the ones that voted for Trump, just like in the UK, the ones that voted for Brexit. People in the north and even Wales, it's these local economies that are really suffering now. The winners are hedge funds and investment banks, of course. So I like this graph here because it shows the green area is the months, obviously it's a positive, and red is negative, and event-driven strategies. Now these hedge funds, they all employ high-frequency algorithms, which operate in nanoseconds. They front-run announcements, and they're tuned to FOMC in particular. And at the beginning of 2020, they lost a lot of money because this COVID came out of the blue, and this stock market crash of, decrease of 15% in the S&P 500 was made a lot of losses for hedge funds across the board, not just event-driven strategies, but equity strategies, relative value strategies, macro, and all of them. They all made a loss, and they still have in the year to date. But the monthly profits are significant. For example, equity strategies made 7.37% in 1 month in April. and they made 3.63% in a month in May. Still maybe down over the year to date, but hedge funds, any volatility is good for hedge funds. They just train their algorithms to the current market circumstances, and then they just rake it in. And investment bank fees hit a record in the first half of 2020. That's this headline here. And why is that? Because they're underwriting new bond issuances, and 37% rise in fees tied to stock sales as well. So it's not just in the US, it's also happening in European banks, in particular Deutsche Bank, which is the sort of pet bank of the ECB, has made profits up 150% on the same period last year. The losers are the US consumers. Today, there is 14.3 trillion of household debt, 14.3 trillion. In fact, there was 13.3 trillion before the banking crisis in 2008. But most of that was a lot of that anyway, was in mortgages. Now, it's not so, the mortgage situation isn't so bad at all, but consumer loans have been massively securitized by peer-to-peer lenders as well as banks. And these loans are not just in the form of mortgages. In fact, they're mainly in car loans, loans on credit cards because they want to buy TVs, they want luxury goods. These are ever more affordable as things like healthcare, good education, and other necessities become less affordable. So this consumer debt is a real consideration for the Federal Reserve now. And the CARES, COVID Aid Relief and Economic Security Act of 27th of March, has so far injected about 3 trillion in packages to help small businesses and consumers to try to prevent another wave of credit defaults, as there's been over 50 million new jobless claims in the US since March 2020. That puts our 600,000 in perspective, I think. In fact, some say that the real unemployment rate, if you don't keep changing the way it's counted, as we did in the Thatcher years in the UK to sort of mask the real unemployment rate, some say it's nearly 24% or even more. So it seems that not just from household debt, but also company debt, a credit crisis is on the horizon. The term asset-backed securities loan facility is something that is being rolled out not just by the Federal Reserve, but BlackRock, which is the largest asset manager. It has another 7 trillion, keeps coming up that number, of assets under management. So together, the Federal Reserve and BlackRock are buying 300 billion worth of securities, households, mortgages, car loans, credit card debt, student loans. Student loans have just been going up and up and up, just a linear trend. Most of those student loans actually have been securitized by peer-to-peer lenders, in particular. Sophie is a very big one I don't know what's going to happen with that securitization, because they're being sold on to companies that could be systemically risky. Anyway, the Federal Reserve and BlackRock also buying new corporate debt and being underwritten by investment banks. So credit lines of up to 4 years are being given to investment grade companies. General Motors has a credit line of at least 2 billion for up to 4 years. So it can just borrow up to 2 billion to keep the automobile industry in the US afloat. All these loans, Chrysler too, just as it was after the banking crisis, only much, much bigger. They're also buying corporate debt in the secondary market, smaller companies that may have their debts in exchange traded funds, which are another target for BlackRock. And larger corporate bonds, AT&T, even Berkshire Hathaway Energy are being bought by the government and BlackRock. Now the Exchange Stabilisation Fund is being used again, this time to bail out money market funds. 500 billion is going to the ESF from the CARES Act for general bailouts, particularly for the money market. And now it's not that investors are running on the money market because they think the banks are going to default. It's not that. It's rather that the interest rates are zero or even negative. So money market funds are just not giving any return to investors. So they're again threatened. So far, Goldman Sachs has spent $2 trillion bailing out its prime money market fund. Bank of New York Mellon has also done that. But this CARES Act, the Exchange Stabilisation Fund, will also be bailing out money market funds to try to keep liquidity at the short end of the market. So to summarise, what's happened is that the Fed has these last resorts to supposedly stabilise financial markets, where it's acting as a lender of the last resort to investment funds. As I just said, the ESF is used to guarantee money market funds again, to a much bigger extent. It's acting as a lender of the last resort to security firms. So the primary dealer credit facility gives funds direct to the primary dealers, to the big banks, you know, Goldman Sachs and so forth, in their interactions with the Federal Reserve on open market operations. It's acting as securities dealer of the last resort because it's intermediating in both sides of the repo market. Not only is it doing direct repo and buying Treasury securities to inject cash, but it's also doing reverse repo and selling Treasury securities to take back the cash. It's acting as a securities underwriter of the last resort, for example, for General Motors or other investment-grade corporate bonds up to 4-year maturity. And it's acting as a securities buyer of the last resort because it's buying US bonds and exchange-traded funds on the secondary market. So the Federal Reserve has taken over financial markets completely. And it's not just the Federal Reserve. The quantitative easing went global a while ago. In fact, this graph here tracks the debt to GDP level in blue line, that's the developed countries, and the red line is emerging economies. And the last few years, this rise in the debt to GDP ratio in emerging companies, it's now 60% debt that they have as a proportion of their GDP, is because they have been using QE as well. And the levels of debt to GDP on average in developed economies is now the same as it was at the end of World War II. So we've racked up all this debt without even being in a war. I mean, to be honest, a lot of that is skewed by the fact that China, the debt to GDP ratio is over 300%. But China has not been using QE. China has been racking up debt for direct targeted intervention, just like the Chinese government did following the breakdown of the silver standard and during the Great Depression in the rest of the world. They funded infrastructure, they reformed laws, and this is what's happening now with the Chinese economy, that they're building. I mean, the property market in China is, you know, a lot of households have 2 or 3 properties, so there's an awful lot of debt there. Anyway, so back to the right-hand graph, you can see again the S&P 500 during this fall from 3,400 down to 2,200. So that's almost 20–25% fall over the space of a couple of weeks, and then rebounding. But at the same time, the dollar was used to defend the dollar value of the S&P. So for foreign investors, what they lost on the equity, they at least gained on the dollar. However, and this is not normal to have this negative correlation between the S&P 500 and the US dollar. Normally, as people want to buy stocks in an economy, they need to buy the currency in order to buy the stocks. So the demand for both of them should rise hand in hand, but not when the Exchange Stabilisation Fund is doing what it likes with the value of the dollar. And not surprisingly, I mean, this was in June and it's going down still, because just in the same way as Theodore Roosevelt devalued the dollar after the stock market crash during the Great Depression to try to boost exports, this is exactly what's happening now. The trade-weighted dollar index will be going down and down unless it has to boost the value of US stocks. This is a moment where I can plug my latest book. It's just an edited book with my friend Douglas Cumming. It's 625 pages with 21 chapters on how corruption and fraud in financial markets operates through a series of misconduct or manipulation, malpractice, and so forth. So this was published in May this year. And on the right, I show you the COMEX gold futures, and anybody who deals in the COMEX markets, not just gold, silver, copper, all these futures on precious metals and other commodities are highly manipulated. And the CFTC, the Commodities and Futures Trading Commission, is supposed to police the CME. But, you know, I know traders who report manipulative trades almost regularly every Friday and nothing is done about it. This was a very, very large manipulation during the period when the S&P was falling here, so that people didn't rush to safe havens like gold. There was a huge sell order on gold futures, as always on a Friday afternoon, to suppress the value of gold. So the ESF but they don't want to suppress the value of gold entirely, because after all, the US still has the largest amount of gold in the world, second only to China and Japan. But they need to keep a cap on gold because they want US assets and the dollar to be the safe haven. Bitcoin as well. This was a headline on March the 6th when this crash occurred in the S&P. Everybody was expecting Bitcoin to take off to $20,000 again or whatever, and all cryptocurrencies to rise. But a different form of manipulation was used, which is very easy on these cryptocurrency exchanges, which are out of the US and they're not regulated. And you can just watch what we call the limit order book, and you can see special trades called pings or spoofs or layering and different kinds of orders that aren't real orders. In fact, 95% or more of these orders are cancelled. They're just put there to try to move prices. But in fact, this DDoS attack is a different type of manipulation where an exchange like BitMEX or Bitfinex, located goodness knows where, and Singapore at the moment, or it could be the Bermuda because they're not regulated. The exchange is flooded with computer requests, so much so that it goes down. It's called a distributed denial of service attack. Just before that happens, somebody puts a very, very large sell order, massive sell order, and then no new orders come. And so the sell order keeps eating its way through the order book, and the price goes down and down as it starts eating up these other orders. And then when the price has gone right down, that person who put on the sell order and sold most of it at a higher price can now buy back at a lower price, open up the exchange by stopping the DDoS attack, and then when the price rebounds, sell again at quite a large profit. So this is what happened in Bitcoin at the time as well. Now, finally, we should mention what's happening in terms of the ECB measures. The ECB Pandemic Emergency Purchase Programme recently offered 1.3 trillion euros at negative interest rates for banks to, first of all, so in other words, they can take a loan from the ECB and be paid for it. It's a negative interest rate. So they're paid to take money from the ECB. Now, admittedly, about 60% of that needs to go back to the ECB because these banks have loans with the ECB that are maturing. But the rest of it can be used. For example, if I'm Monte dei Paschi, I'm paid by the ECB to take money, and then I can buy red bonds. I can buy Italian government bonds, which give me something like 7% interest or 5% interest. So there's what we call a carry trade. It's an instantaneous and highly profitable carry trade. There are these other Coronabonds, but they're not going to be enough to go round. So Italy, Greece, and so forth, all these yellow countries that agree with Coronabonds, i.e. a universal bond backed by all the member states, and therefore it would be guaranteed by the health of the German economy, the Dutch economy, and so forth. But these Finland and Holland and Germany and Austria, they don't agree with these Coronabonds because they think it would be no incentive for Greece or Italy or Spain to reduce their amount of debt that they have. So there will be country-specific limits on these Coronabonds when they do eventually come out, and government bonds will still be necessary. To summarize, here's a picture of my favorite picture of, not that he's my favorite picture of Donald Trump. That was when he was explaining how one should drink bleach to cure COVID. And on the right, here's the most recent graph that compares the number of outbreaks of COVID, 7-day averages in the US compared with the EU. You can't get, this is Johns Hopkins, but you can't get the graph like this at the moment, although the number of cases per day is still going up and up, 60,000 cases yesterday from the Johns Hopkins University website. So with the lockdown that should have enforced, and many states are going back into lockdown, there's going to be huge unemployment in the US. It's bound to reach double figures, higher than it was during the Great Recession of the 1930s. And we've seen how much debt is being racked up, not just by the US, but also by the ECB. Debt is now not going to be 1.2 times GDP, but averaging 2 or 3 times GDP for the next few years. Unemployment will be a very deflationary pressure. So whereas it's always nice to inflate debt away, so when you take it on, it was whatever, 1 million, but 10 years from now, 1 million isn't worth very much because of inflation. So that's a typical economic policy, is to inflate debt away. But you can't do that because unemployment is very deflationary. The demand for goods and services and products and manufacturing is bound to go down. So the only thing that countries can do is to increase exports again. So that's why this negative interest rates, which perversely are sort of a good signal, interest rates becoming negative have led to a revaluation in initially in the euro, not now though, the euro is going down, but in the yen. It's a sign of economic control that money markets respond to. But as I said earlier, I'm sure that the US dollar is going to be going down as much as possible, not just because of negative interest rates, but also because of the Exchange Stabilisation Fund. We're going to see a lot of competitive currency devaluations along with trade tariff wars. The news this morning about the Huawei deal, the UK under pressure from the US to drop it, and then China retaliating, saying why should they invest in the UK infrastructure. This is just the beginning. And at the same time, financial markets are no longer a free markets economy. That's gone completely. capital markets are completely nationalized, to the point where we're now seeing yield curve controls, as have been used in Japan for a very long time, to prevent buying long-term debt, to prevent interest rates going up too much at the long end and suppressing interest rates all the way along. Negative interest rates at the short term and very, very low interest rates all along the yield curve. So that's all I have to say. And I look forward to seeing you at Sussex. Bye for now.